Good morning, everyone. Welcome to the Northeast Forest Products Industry Outlook, brought to you by Farm Credit East Knowledge Exchange. It is Tuesday, April 9th, 2024 at 10 a.m. and let's get started. Just a quick disclaimer before we begin that this information is presented in good faith, but is not intended to be investment, tax, or legal advice. We have applied in advance for continuing ed credits from several states, as well as the Society of American Foresters. Some states do not do pre-approval for continuing ed credits, but will accept proof of attendance for CEU credits. So please email me, chris.lawton@farmcrediteast.com for information if you require proof of attendance for your credits. I will also be presenting this email at the end of the webinar as well, so you'll have another chance to write it down. So today's presenter will be Paul Jannke from Forest Economic Advisors. Paul's main area of expertise is North American lumber markets. He has spent the last 25 years analyzing lumber markets and providing reliable, insightful forecasts. And as such, he is known as the industry's top economic analyst. So without further ado, let me change the presenter to Paul and let him share his screen. And then I'll let him take it away.
All right, thanks, Chris. I appreciate that. Can you see my screen?
Yes, we see your title slide.
Excellent, sounds good. Well, thank you for joining us today. I appreciate you taking the time. I'm going to talk about where we see the North American lumber markets going with as those of you who've sat in on my presentations in the past know, we do cover all of North America, but I'll be looking a little bit at the Northeast as well in this presentation, in particular on the pricing slides. So if I can find my cursor. So this is, I don't know, it's the fifth year. I've been doing this with you folks. I know it's been a number of years now. So when I started my presentation, I started off with what I talked about last year. And these are the take-home points that I talked about last year. I mentioned that the probability of a recession was high, but that probability was declining. We thought that lumber markets were going to slip in 23, but if the downturn that we were going to have would be more mild than previous recessions. We talked about costs being elevated and so prices remaining high relative to history. We talked a little bit about the expanding capacity, but the difficulty that we were going to see in reaching nameplate capacity. And then export markets remaining weak and imports were going to remain decently strong. So I thought that was pretty interesting because pretty much all of this had taken place as we had forecasted. Then the other interesting point is that really not much has changed for this year. So you'll see when you see my take-home points at the end of this that a lot of this is the same. We do think that markets, so we no longer think, I'm just going to jump right into it. We no longer think that there's going to be a recession. So we think that we actually managed to get through this period of rapidly rising interest rates without slipping into a recession. There still is a lot of risk to that forecast, and so we do think that the economy is going to slow going into the middle part of this year, and I'll talk a little bit more about why that is. But you can see from this graph, which just shows you the GDP growth, that we don't have any negative GDP growth, so no recession in 2024-25. So why is it that we took out that recession? Well, to understand that, I think that you need to look at why the economy slowed, and the reason is the rapid rise in the interest rates. So, I'm actually going to skip up one slide and then I'll go back. So, what do I mean when I say the rapid rise in interest rates? What this shows is the past half dozen or so periods of the Fed increasing interest rates, and it shows you how quickly and how far they raised interest rates over those past 6 or so periods of rising rates. And you can see that this period that we saw in 2022 was the fastest and highest rise in interest rates that we've seen in 40 plus years. So it was really, in recent memory, it's unprecedented how quickly and how far the Fed raised interest rates. And why was that? Well, that goes back to this slide right here, they raised interest rates so quickly because inflation had popped up to 9% at its peak. So why do we think that why do we think that we no longer are going to have a recession? Well, for one, we think that the Fed is done raising interest rates. And in fact, we think that starting around middle of this year, we'll start to see interest rates decline. So that, there's obviously some risk to this. The Fed has come out a number of times and said that, it's not guaranteed that they're going to be lowering rates this year. But in any case, the Fed is done raising interest rates. We think it's highly unlikely that we're going to see any more interest rate increases. Most likely from our forecast is that we're going to see rates start to decline in the middle part of this year, with a little bit less likely scenario being that they stay flat. Again, why is that? Well, we think that inflation is actually under control at this point. So I know that the headline rate is a little over 3%. On a year-over-year basis. But if we're actually looking at the last 3 months compared to the previous 3 months, so on a shorter term basis, what's happening with inflation? So this isn't month over month. So we're getting a little bit longer time frame. We're doing 3 months over 3 months, but we're taking the most recent 3 month period and comparing it to the previous 3 month period just before that. And you can see that if we're looking at CPI less shelter, or the Fed's preferred measure, which is the core PCE, we're down right around that 2% inflation target that the Fed is trying to get to. So this indicates to us that as we move forward, we're going to be seeing those year-over-year comparisons pushing down towards that 2% rate that the Fed is targeting. So we think that's a good indicator to us that the Fed is done raising, and we might actually start to see them drop interest rates as well. Why is it that inflation's come down? And it's not just looking at this history. We can also look at some forward-looking indicators as to why inflation is likely to stay low. And one is that for inflation in the U.S., a big component of inflation is actually housing costs. So if we look at various measures of housing costs, here we have Apartment List and Zillow, we can see that those rates are that the rate of increases in rents are either down, well, in either case, they're below the historical, the 2018 to 20 period. They're sharply lower from where they were in the 2021-22 peaks. And a lot of that rapid rise that we saw in inflation was driven by this sharp increase in housing prices. I know those housing prices have come down significantly back to historic levels or even below historic levels in terms of the increase in housing costs. So that's certainly going to keep downward pressure on inflation and help to push that down. In addition, we have to look at what caused inflation to rise so sharply. So one of the things was the fact that housing costs were moving up, but another one was that because of the pandemic and the extended supply chains that we saw prior to the pandemic, folks were having trouble getting goods to market. And we could see this in the supplier delivery times. And we saw that big spike up in supplier delivery times that occurred during the pandemic and then post-pandemic as well, as we saw continued shutdowns in China. And also we saw transportation disruptions across the US because of and production disruptions across the US as well because of a retiring workforce that occurred during COVID. So we saw that big increase in supplier delivery times. Inflation is a rise in prices, and price changes are caused by changes in supply and demand. So we had supply decline because of the increase in supplier delivery time. So that helped to drive up prices. Well, since then, supplier delivery times have come back down towards normal levels. And in fact, they're still slightly below the long-term trend, a bit up from where they were in 23, but still quite low. So we're no longer seeing those supply side constraints that would help to push up inflation. In addition, for the Fed to really be concerned about inflation, you really need to see it feeding through into wages. And if the inflation doesn't feed into wages, then you're not going to see a continued upward spiral in prices. So one of the things that we like to look at is where do we think that wages are going to be going forward? And so what we did here was we overlaid the the Atlanta Fed's wage tracker, which is in red, lagged 6 months over the quit rate. And the reason for that is because if you think about it, if we have a high quit rate, then folks are going to be more likely to be able to get a job with higher revenue, right, with higher income, right? So you wouldn't quit your job unless you have an opportunity, or folks wouldn't quit their jobs at high rates unless they had the opportunity to take another job. And generally, if they're taking another job, either taking it because the position is more desirable, the work is more desirable, or more likely because the pay is better. So we can see that when we overlay the wages over the quit rate, we can see that it follows really, really closely. When a lot of folks are quitting, they're quitting to take jobs with higher money. And then as that quit rate goes down, we see that wages actually the rate of increase in wages go down as well, because folks are much less likely to be going to their boss and saying, hey, I can get a job with a higher pay, so I'm going to quit. So that's not likely. So what we see here going forward is that quit rate has continued to drop down to just a little over 2%. And so we would expect to see wages continue to come down over the next 6 months still as well. And some might say, well, we had that big increase, you still had this big increase here in wages, and so that's going to lead to higher inflation going forward. But actually, productivity has increased as well. So that we've seen a fairly substantial increase in productivity, and we can have wages increase without it being inflationary if we have an increase in productivity as well. So from the labor front, we don't see a lot of upward pressure on prices coming from higher wages going forward. What about trade? So the dollar is about 13% above its long-term average. Having a strong US dollar means that imported goods are cheaper. And so that helps keep downward pressure on prices as well. And then China is in a deflationary environment right now. So, and they're exporting that deflation. So in other words, costs in China are going down because they're in a deflationary environment. And as those costs are going down, the cost of producing goods that they're exporting are going down. And so we're seeing export prices go down as well, along with that decline in Chinese prices overall. So from an inflationary perspective, we do expect to see inflation. We think it's under control. We think it's going to continue to come down towards that 2% target, and because of that, we think the Fed is going to lower rates. And so that's a good sign for the overall economy. How about the labor market? If we're not going to see a recession, it's not just it's not just lower interest rates, but we need to have also need to have strong labor markets. And so you can see what this graph shows here is the number of job openings per unemployed person, per unemployed persons or people. And so a reading of 2 means that there are 2 job openings for every unemployed person. In other words, there's no way you're going to be able to completely fill your vacant workforce. And a reading of 0.2 means that there are 5 people available for every job that's open. So in that environment, you'd be in a very recessionary environment if you had 5 jobs available. I'm sorry, if you had 5 people for every job. But you can see that we're at 1.36. So we have about 1/3 more jobs available today than we have people. So that means that if someone wants a job, if you're unemployed and you want a job, as long as you're willing to move to where that job is, you will be able to find a job. So the labor markets are strong. So that's a good sign telling us that we're not likely to slip into a recession, and that we're actually likely to see some growth, some modest growth in 2024. Another reason to be optimistic is that our balance sheets are in great shape. So what this shows is your financial obligations as a percent of disposable income. So what percent of our income do we spend paying our interest back is essentially what this is. So it does cover a bit of principal as well, but most anybody who has a mortgage knows, unless you're far into your mortgage, that most of what you're paying back is interest. And you can see that if we take out these 2 periods where we had these big spikes down during COVID, this was the federal government transferring money. This was when we got our COVID checks, right? So this is just simply a transfer of money, which drove up personal disposable income. because that was a transfer of income to households, and that drove down, that's the denominator, so that drove these numbers down. If we take out those spikes down, you can see that we're just following this trend that started at the beginning of last decade. Really, it's sort of, I guess the downward trend started in the middle of 2 decades ago. We're continuing to follow this trend down in that our financial obligations as a percent of our income continues to go lower. So what does this mean? Well, this means that we're in pretty good financial shape, and if we do, so we're not as at risk for default on our loans. And on top of that, if we do start to have the economy slow, folks start to lose their jobs, we have a lot of cushion where we can tap into quite a bit of credit before we get anywhere near back to where we were before prior recession. So that's just a little bit of cushion for folks to spend with. And that's the same as this slide right here. So this is another slide that gives us cushion. So folks, if we do start to see the economy slow, folks start to lose their jobs, they have some excess savings that they can tap into. Now, they don't have anywhere near the excess savings that they had back in 2021, but we still have over $100 billion worth of excess savings. So it's quite a bit of money that folks have as a cushion in case the economy starts to slow a little bit, that will prevent us from slipping into a recession. And finally, I think this slide might surprise a lot of folks. So we all know about the fact that interest rates are currently at about, just a little under 7%. Mortgage interest rates are a little under 7%. This is the last quarter they're a little over. It was 7.3, but for the past month they've been down around 6.8 or so. But in any case, I think most folks know about how high mortgage rates are. And that's certainly going to affect, it certainly has and will continue to affect demand for new homes and people's ability to buy new homes. But if we're looking at this from an overall economy perspective, we don't really care as much about what the current mortgage rate is. What we care about is what are folks actually paying. And that's that blue line, that's the effective rate on debt outstanding, mortgage debt outstanding. So you can see that that is significantly lower than the current mortgage rate. So in other words, on average, folks are paying 3.8% interest. So they're not paying 7.3%. That's only for the folks buying and going out there and buying a home today. So certainly that is going to impact folks' ability and desire to purchase a home. But in terms of folks' ability to maintain their current mortgages and continue to spend money, then you want to be looking at that 3.8%. So that's a much more favorable number. So that's a lot of good news, I think, on the economy side. We have interest rates that are stable to likely falling if we're looking at short-term interest rates. Longer-term interest rates have, they have started to go up recently, but the spread between the mortgage rates and the 10-year bond has started to narrow. I'll talk about that in a little bit. So that the rising longer-term rates aren't as affecting mortgage rates quite as much. But in any case, lower short-term rates, which should help to boost economic activity. We have strong labor markets. We have good balance sheets, and we have a lot of excess savings. So there's a lot of reasons to be optimistic about where the economy is going to go. But as I said early in the beginning, there still is a risk that we are going to see a recession. We don't have it in our forecast, but we do have a slowdown, and we do have, in any case, even if it's not a slowdown, we have continued tepid growth through 2024. Why is that? Well, if we look at the New York Fed's recession indicator, it still shows an almost 60% chance of a recession. So the Fed is still saying that a recession is likely within the next 12 months. If we look at the index of leading economic indicators, we just saw the first positive reading in the past 24 months in February. So, and if you look at in the past, those gray bars show recessions, and prior to every recession, we start to see a downturn in these leading economic indicators. And we've had we had essentially 2 years of declines in the leading economic indicators. So that's a sign that we should be cautious about our outlook for this year. If we look at non-mortgage debt, we can see that the interest payments on those have surged, and that makes a lot of sense, right? Your credit card debt you know, that with interest rates rising, then your payments on that debt is going to go up. So, you know, it's gone from 2.5% to almost 5%. So that's as a share of your income. So that's money that you can't spend on other things. It's getting spent to pay the interest on your outstanding debt. So those are goods and services that you can't buy. So that's going to be a damper on overall economic growth as well. And then just a final reason here as to why we want to be cautious about our growth prospects for 2024 and into 25 is that the yield curve is still inverted. So just quickly, the yield curve is the 10-year treasury minus the 3-month treasury. So the reason why this is important is because banks borrow money short term and they lend money long term. So if you're a bank, if your yield curve is inverted, if it's below 0, that means that your short-term rates are higher than your long-term rates. With banks borrowing short and lending long, they're not going to do that if your short-term rates are higher than your long-term rates, because the cost of money for the bank is more than they're going to get when they're lending it. So that's why we see prior to every recession in the past, we've always seen whenever the yield curve inverts, we see the economy slip into a recession. So it hasn't happened this time around. If it doesn't happen, it will be the first time that we haven't seen the economy slip into a recession after the yield curve is inverted. So again, just more reasons to be cautious for for this year going into next. All right, that's enough about the overall economy. So essentially, no recession, but slower growth for this year is our forecast, and then growth starting to accelerate as we get into 25. So what does this mean for housing? Well, we have a very boring housing forecast, actually. We're looking for housing to be essentially flat, right? So 142 last year, 144 this year, and then bouncing up to 156 in 2025. So there's all sorts of things going on in the housing market, you know, all sorts of contradictory forces playing on the housing market. We have we have high interest rates, but interest rates coming off. We have strong pent-up demand, strong demographic demand. We have no existing homes out there, and then we have a bunch of supply-side constraints from the builders. So there's all these conflicting forces, and our assessment on all of those is that, you know, going back and forth, we're not likely to see a big increase in starts because of the high interest rates and the supply-side constraints, but we're also not likely to see a big decline in starts because of the strong pent-up demand, the strong demographic tailwinds, and the fact that there's not a lot of inventory out there. So we're looking for essentially a flat housing starts forecast. One thing that you will see, real quick to get into 25. So some of the supply side constraints will start to ease as we get into 25. Plus interest rates will start to come down, so that should help to bolster starts, and that's why we see a bit more of a jump in 25. One of the things you'll see in looking at this chart, if you look closely, you can see that the red bar moves up a lot more than the maroon bar from 23 to 24, and that green portion declines, right? So that's just the single family versus multifamily share. And so what our forecast calls for is an increase in the single family share. We had a lot of multifamily homes built over the past couple of years. And so there's a glut of multifamily homes available. And we also have, because of the age class distribution of our population, a lot of folks in those prime single family home buying years. We do expect to see increased demand for single family homes. So that should help to bolster the single family share. So that's going to be even though we have essentially flat starts, there's going to be a disproportionate increase in lumber demand because you use about 3 times more lumber and panels in single family starts than you do in multifamily starts. So, all right, so and I'll get into, I talked about a lot of the rationale, but now I'll just show you some of the graphs so you can see it. And so this shows us interest rates. And you can see that interest rates have come off from their peaks, which is good news. They still remain elevated, which is going to prevent us from, that's one of the things that will prevent us from seeing housing starts at say 1.6 or 1.65 this year, is that we still have elevated mortgage rates. But this graph, I had actually alluded to this graph a little bit earlier, which is if you look at the spread between the 30-year and the 10-year, it might be a little difficult to see, but as we see those 10-year yields start to increase, we see that spread increase as well. So that spread went from its historical average of about 1.8% between the mortgage rates and the treasury yield. That spread went from its historic average of about 1.8%. It shot up to over 3%. It's since started to come back down. So the reason why it started to increase was because as your treasury yield starts to rise, as it rises from month to month, if someone goes to take out a mortgage, they're locking in a rate 30 or 60 days out. And so for a bank who's in a rising interest rate environment, if you're locking a rate in today, you know that you're not going to be lending that money until 60 days from now. So you know that the interest rate is going to be higher in 60 days from now than it is today. So you're going to want to increase that spread between the current 10-year treasury yield and what you're going to be lending for, in 60 days from now. And by the same token, as interest rates start to fall, banks can start to narrow that spread back again. So we've seen that spread start to narrow. So if we're seeing a bit of an upward trend again in the 10-year treasury. As this starts to come down again going forward, we would expect that spread to narrow as well. And so we would expect to see mortgage rates continue to come off. I had mentioned that there really are very few homes out there for sale. So if you want to buy a home, if you're in the market for buying a home, it's difficult to find a home because the inventory of new single-family homes is so low. So it's up from where it was during the pandemic, but it's still very low relative to pretty much every other year in history outside of the pandemic era. So that means that, that's just, there's not a lot of homes for sale. So if you're a builder, there's a lot of incentive to build homes, to put homes onto the market as demand remains strong. So the next couple of slides are more longer run. They're more longer run, but they also impact our forecast for this year as well. And that is the amount of pent up demand that's out there. So what this graph shows is underlying demand in the green line. That's what our average housing starts should be over an extended period of time. And then the red line shows you actual starts. And you can see that housing starts cycle above and below the green line, but on average through the mid 1990s, housing starts had equaled underlying demand. Then we had a period of about 10 years here where housing starts were above underlying demand. And so we had a bunch of spent up demand. We built too many homes. That led to the Great Recession. And so all of this spent up demand that had occurred here, that was all made up for by 2010. So this period, this area right here under the green line from essentially 2006 to 2010, that area is equal to this area over here. And so from 2010 on, 2011 on, we've been building pent up demand. We've built fewer homes than our population growth would demand. And the evidence of this is simple. If you look at the massive, rapid, and large rise in interest rates that we saw over the 22 period, and then you look at home prices, and they barely fell at all. And in fact, home prices are almost back up to their peaks. So we have a massive increase in interest rates, so which should dramatically dampen demand for housing, and we barely saw any decrease in demand for housing at all because there's so much pent-up demand out there. In addition, there is really strong demographic tailwinds. So what this graph shows is our population by age, and we've highlighted in yellow that 27, 28 to 34-year age bracket because those are your prime home buying years, and in particular your prime single-family home buying years. And what you see in this graph is that our peak population right now is it's in their prime home buying years. So that to us indicates that there's strong demographic tailwinds, which should also help to bolster demand for housing going forward. So that's a lot of good news, right? We have elevated but falling interest rates. We have not a lot of homes for sale, so we need to build more homes to build back our inventory. We have a tremendous amount of pent up demand, and we have strong demographic tailwinds. How come we don't have housing starts at 1.6 or higher? Well, part of it is as interest rates, and I'll get to that in a second. But another part of that is that there are a tremendous number of supply side constraints. So this just lists out supply side constraints for remodelers and home builders. And you can see that, across the board, they're showing supply side constraints on framing crews, carpenters, both rough and finish, plumbers, just all across all of the trades. There's a shortage of labor, which is supplying supply side constraints. And then if we're looking at some of the key problems from 23 and 24, we had similar problems as well. Building material prices. We have local, state environmental regulations and policies, high interest rates. So all of these all of these factors are going to be leading to continued downward pressure on housing and preventing us from getting to that 1.5 to 1.6 million unit level. Another factor, and this is, another factor that's out there is the fact that we've seen a tremendous amount of concentration in home builders following the Great Recession. So we lost a lot of the small builders, and as a result, one of the things that's occurred with this concentration is that we're seeing builders profitability has shot up to record levels, actually. So gross margins for builders are at record levels. So this graph right here shows you the single family construction price index versus the home price index, and you can see those two diverging. So this is showing you, although the builders complain a lot about high cost of materials, the reality is material costs have been falling while home prices have been going up. So builders are making record profits. And with that high concentration of builders, how do you kill record profits? You kill record profits by jacking up production and oversupplying the market. So what we're seeing is there's not a lot of incentive for builders to actually go out and build a bunch more homes because of this high concentration that we're seeing and because of the record profits that we're seeing right now. In addition, I had mentioned the higher interest rates early on, and that is continues to negatively impact demand for housing, even though it's still strong because of the strong demographic tailwinds and the tremendous amount of pent-up demand. But still, you can't get away from the fact that it's still almost 60% more expensive to pay for a home today than it was at the beginning of 2022. So we've gone from $1,300 your principal and interest payment on a single family home, 80% of a median single family home has gone from $1,300 up to a little over $2,000. So that definitely has a dampening effect on demand for homes. So so that's why we have a lot of positives, but there's also some negatives. So on balance, we see housing starts increasing just a little bit. We do see that shift towards more single family as opposed to multifamily because of the age class distribution of our society and the overbuild on the multifamily side over the past couple of years. So the other big market for our products are residential improvements, so repair and remodeling, additions, alterations, improvements, those sorts of things. And you can see our forecast for this is to come off a little bit from where we're at right now, but then to remain above trend. So why is that? Well, obviously the higher interest rates those are certainly going to affect R&R activity. In addition, we had this big spike up, and some of this was probably borrowed from the future. So that's all reason and rationale why we see it coming down a little bit more. But why is it that we're going to remain above trend? Out through this forecast only goes through 25, but we have it remaining above trend through 27. So we have strong R&R activity for quite a while. Well, one of the reasons, this is more short term, is that the high interest rates that we're seeing today and what I would call rate lock that is that a lot of folks have, well, on average, folks have 3.8% mortgages, but a lot of folks obviously have mortgages that are down around 2.5 to 3.5%. So those folks are locked into their current mortgage, given that if they were going to move up, they would be paying a mortgage rate that's 4 percentage points higher than what they're paying today. So we call that rate lock. Folks are locked into their homes because they don't want to trade up and move up and take on a much more expensive mortgage. So what we're seeing households doing is we're seeing them fixing up rather than moving up. And we can see that in the data for existing homes for sale. For existing homes sold, not for sale. And you can see that in 2023, our existing home sales were at the same level that they were during the Great Recession. So folks are definitely fixing up rather than moving up. And I'm sure there will be a number of people on this call who are saying, yep, that's the thing that I'm doing as well, because every time I do this presentation, I have 3 or 4 folks come up to me, especially younger folks in their late 20s or early 30s who had bought a home with, say, 2 bedrooms or 3 bedrooms with a plan on, they did it in 18, 19, and their plan was to move up and buy a bigger home as their family grew. And I can't tell you how many times folks come up to me and say, yeah, we had this plan. We were going to buy a bigger home, but we can't afford the higher mortgage, so we're simply adding on to our house. So that's certainly going to bolster R&R activity. In addition, and this is a slide that I've shown you in the past, and that is that our housing stock is old, and with the old housing stock is also small, right? So our home sizes have gotten a lot bigger over the years, and on average, our housing stock today is about 22% smaller than an average new home that's getting built. So if you're living in an average home, a median home from that's a median existing home, on average, you're 20% smaller than what's getting built today. So you're going to want, if your plan was to eventually move up, you're going to want to add on to that home. In addition, this happened during COVID. We saw a rapid increase in work from home, and as work from home increased, folks needed to expand on their homes to add office space. They're spending more time at home, so they because of that they wanted to have larger homes. And we've seen that during COVID that work from home shot up to 60% of our working days at home. That's now dropped, but it's still well above the 8% or so that it was at prior to COVID. It's currently bouncing around 30%, so it's still well above where it was. So that'll continue to drive up demand for additions and alterations and improvements as folks spend more time at home. If you are going to do those additions, alterations, and improvements, you need to be able to get money. And the good news is that our home equity is not at record levels, but it's near record levels. So home equity is quite high, and so folks have a lot of equity that they can tap into in order to make those improvements. And then just a final note on this is that banks are not going to be shy on lending money because the delinquency rates on lines of credit remain low. We have seen mortgage delinquency start to move up, still very low, but moving up a little bit. Whereas with a line of credit, those delinquency rates remain extremely low right now. So banks are going to be continuing to loan money to folks to make those improvements. So that those are your 2 main end-use markets for lumber and panels. Those being new residential construction and additions, alterations, and improvements. But there's another major market, which is that for industrial markets, and in particular for some of the lower grades of lumber, which obviously for those of you who produce lumber on this call, and for those who don't, there's only so much 2 and better lumber that you can get out of a log, and with every board of 2 and better that you're producing, you're also producing economy and utility grade lumber, and so you need a market for those. The main markets for those are industrial, so packaging, pallets, crates, dunnage, that sort of thing, goes into furniture as well. And what's the outlook for industrial markets? Well, for one thing, our capital stock is very old. It's at the oldest it's been in a century, essentially. So that means that outside of any other influences, because of the age of our capital stock, we would expect to see businesses increasing their investment. But it's more than that. One of the things that we saw during COVID was we saw that those long supply chains prevented companies from getting goods to market. And so we saw there's just a natural desire to shorten those supply chains. On top of that, the political environment for the past essentially 8 years at this point in time has been one of bring the manufacturing back home. So starting with with tariffs on imported goods, leading to massive investment of our taxpayer dollars into domestic manufacturing, right? On the order of the CHIPS program, on the order of $1 trillion+ getting invested of our tax dollars to incentivize businesses to build factories in the US. And so there's a lot of money going towards that. There's a political shift in that direction, the increase in tariffs on goods coming in. And then also the desire to shorten those supply chains. We've seen a massive increase in construction expenditures for manufactured facilities. So this one, I mean, I could have showed you all manufacturing. It's similar, it's not quite as dramatic, but if we're looking at computer, electronic, electrical, you see a massive increase in construction expenditures. So these are buildings that are getting built today. So there's wood going into those buildings, and that's great. But the big news for this is this reshoring of our manufacturing today is going to lead to increased manufacturing output tomorrow, which is going to lead to increased demand for packaging, pallets, crates, dunnage, those sorts of things. So that the industrial demand for lumber should remain strong going forward as well. This also incidentally has an impact on lumber output as well, and I'll get into that a little bit later on. So just putting it all together, this shows you consumption. And that's domestic consumption in North America. And you can see that there's we have a bit of an increase in 2024. Interesting, right? Because we have R&R activity being flat to lower. We have industrial activity increasing a little bit, and housing starts being essentially flat to a little bit higher. Yet we still have a 3% increase in consumption in 2024. So how is that possible? That, most of that is being driven by that shift from multifamily to single family on the housing starts. And you can see that in that blue line on the bottom. There's a disproportionate increase in the blue portion of that, and that is that shift towards more single family construction. So if we're looking at demand on North American mills, it's domestic consumption, which is what I'm showing you here, plus exports, and then you have to subtract out imports. And that gives you the demand side of the equation, and then I'll talk about the supply side in a second. So I do want to talk a little bit about trade. Our trade forecast, I want to talk about trade because exports is demand on mills and imports is negative, or it's supply that offsets North American production. So from the demand on mills side, we have our exports, and you can see that those are essentially flat, really down a little bit, but really not much growth at all. So why is that? Well, the green portions of these bars are basically the same historically. Most of the growth or decline that we see over the past 15 years or so is because of China. And what's happening in China? Well, China is in really rough shape in terms of its overall economy. They are, they're likely to see much slower growth going forward. Their population is, their working age population is going to be declining soon. They have a disproportionate share of far too great a share of their economy is based on exporting manufactured goods. And then they also, far too great of a share of their economy was put towards construction of residential facilities. And they have a tremendous amount of actual residential space. So this shows you the square meters per capita in China, that's on your far left, compared to developing countries. You can see that developed countries, you can see that China has more living area per capita than your average developed country. So they have they built a tremendous amount of residential floor space. And so what we've seen over the past couple of years is because of that overbuild that we saw, we've seen construction activity dropping dramatically. So it's half of what it was pre-pandemic. So that's just less demand that we're going to see coming from China. On the import side, this is one of the things I had talked about last year. There was a lot of talk because of the war in Ukraine and the loss of supply, the Russian, Belarus, and Ukraine supply for Europe, that we were going to see European shipments to the U.S. plunge. You can remember from my take-home points that I showed initially that we said that they were going to remain a lot stronger than folks thought, which is exactly what happened. We see them be, down a little bit, but basically flat at their 2022 levels throughout 2023. And so going forward, we expect imports to basically remain around current levels. Why is that? Well, for one thing, the Europeans are at the low end of the cost curve, delivered into So these are Germany and southern Sweden, just a proxy for Central Europe and for Northern Europe. You can see they're at the low end of the cost curve, delivered into the Houston market. Can't deliver it into the Baltimore market in the near term, so not going into there. And I know that that actually will likely disrupt the supply of European wood on a very short-term basis. But once the bridge is cleared out, then we'll see the wood starting to come back in again there. Going forward, we saw, so they're at the low end of the cost curve, and obviously the single most important cost for lumber producers is their log costs. And we can see that the log costs, they dropped in 2023. So they did increase a little bit towards the end of the year, but they still remain low relative to where they were in 21, 22. And they're likely to continue to remain low. And the reason for that is that there's a spruce bark beetle epidemic in Europe. It peaked in 1920, but we still are seeing a decent amount of spruce being killed. And because of that, we're going to continue to see, going forward into 24, 25, we're going to continue to see a relatively high share of damaged wood available for processing into lumber, and that damaged wood is extremely cheap. In addition, European domestic consumption has plunged and it remains weak. We do have it coming back a little bit next year, but in 24, it's likely to be down. I spend quite a bit of time in Europe, and across all markets there, we're seeing declining demand for lumber and declining market activity. So 24 is likely to be down from 23. And so if there's less demand in Europe, that's more demand, that's more product available for export markets. And because they're at the low end of the cost curve, that wood is going to continue to come in. So bottom line on the European wood being shipped into North America, it's because of weak demand in Europe and low production cost, we expect to continue to see continued shipments into the North American market. What about the supply side? Well, I think a lot of, all of us know about the massive investment that's gone into the U.S. South. This is just a map showing new and expanded mills with the green. That's a total of, so from 22 to through 25, that's a total of over 6 billion board feet. So I did throw the red mills in there, which are the closures, and that there's about 2.25 billion board feet of capacity closures. So that nets out to about 4 billion board feet of increased lumber capacity. So a massive amount of increased capacity that's out there, 4 billion board feet. It's a tremendous amount of lumber. How come we haven't seen lumber prices decline more dramatically? Well, for one thing, despite the record high prices we saw in the 20 through mid 22 period, and the massive investment in new capacity, outside of the U.S. South, we've seen capacity decline, or I'm sorry, we've seen output decline in all regions. This is, ignore that year-to-date October. That's actually full year. Let's get rid of that. So that's full year 23. And you can see that outside of the U.S. South, capacity's actually declined, output's actually declined in each of the regions. So, and in the South, we did see, you saw about a 2 billion board foot increase in output, but that's still quite a bit smaller than in the South, it was, closer to 4 to 5 billion board feet of announced capacity expansions. So tremendous amount of capacity expansions. We're not getting anywhere close to the increase in output that we saw in capacity. So why is that? Well, it's very difficult for a mill to reach its nameplate capacity. And the main reason for that is labor. And it's labor not just at the sawmill, but labor at the machinery manufacturers, labor for transporting the machinery, labor for actually building the mill, and ultimately labor for operating the mill as well. So a modern sawmill needs highly skilled labor. It's not what I have here is the output per worker, and the red bars show your existing capacity, and your blue bar shows you a new mill that's being built today. So I just say that's the mills that were built between 21 and 25, and you can see that a new sawmill has about twice the output per worker as a legacy mill. What does that mean? Well, the new mill is a lot more technologically advanced. It relies a lot more on automation. So you need half the workers to produce the same amount of product. And so if it relies on more automation and more higher tech, you need higher skilled workers. Well, what's going on with demand for high skilled workers across the US South, which is where all these mills are going in? What this graph shows, or this map I should say shows, is private investment in advanced manufacturing. So semiconductors, clean energy, biomanufacturing, batteries, that sort of thing. You can see that there's a tremendous amount of investment. So $700 billion, almost $1 trillion of investment across the South where a lot of these mills are going in. So your sawmills are competing with the likes of Hyundai and Kia, IBM, Intel, these high-tech factories which pay good wages. You're working in a clean air-conditioned environment, as opposed to a sawmill where you're working in a rural area. It can be hot, dusty, dirty. So getting workers in has been difficult, and that's something that's going to continue going forward because of all of this investment in advanced manufacturing where the sawmills are located. So while we see a tremendous amount of announced capacity coming online, the actual production is going to increase significantly slower. All right, what about some of the other regions? Well, at the end of the day, your output is limited by your fiber supply. And I think this is a story that we all know, so I won't spend a lot of time on it, but the annual allowable cut in British Columbia is coming off. It came off because of the mountain pine beetle, but then we had the wildfires in 1718, which burned a lot of spruce, which was, there was an emphasis on harvesting pine during the beetle epidemic. So a lot of that mid-decade spruce that they were counting on got burned in 17 and 18. You have to set aside land for the mountain caribou. There's been forest tenure transfers to the First Nations, and we have an old growth deferral. So all of these things are going to drive BC annual allowable cut. So the sustainable harvest levels, the amount that they're going to be allowed to cut down from current levels of 48 down to just under 40 million cubic meters per year. In Eastern Canada, it does appear as if there's a bit of room for increased output. So based on timber supply, the bars show you the annual allowable cut, and the dashed line shows you the current harvest level. But a lot of that, the bars are the biologically feasible allowable cut, or the biological annual allowable cut. But the economic annual allowable cut is actually significantly lower than that, and probably a lot closer to those dashed lines. And why is that? Well, a lot of the wood that's available there is far north. It's in mixed stands, so it has hardwoods. It's much smaller. It's far away from the mills, far away from the markets. Because it's smaller, you have more residuals. Because it's in mixed stands, you need to do something with the hardwood. So it's just economically not feasible to harvest that wood unless we have significantly higher lumber prices. On top of that, you did have massive wildfires last year. I don't have the slide in here, but it's tremendous. Over 40 million acres burned. So a tremendous amount of land burned, whereas historically it had been below, on average, well below 10. So it's a tremendous amount of fires that occurred. So that's going to lower the annual allowable cut going forward, as is the same set asides for the woodland caribou that we're seeing. That's a federal mandate. So we're going to see a decrease in these annual allowable cuts. If we're looking at the U.S. West, similar story here in terms of changes to the Forest Practices Code that we're seeing out there. A loss of about 10% of their sustainable harvest levels. U.S. South is the only region that has any excess supply. That's all of timber supply. That's all of the increasing capacity there. So I do want to spend a little bit of time talking about prices. So what we're looking for prices, this is Eastern SPF price. Sorry, I will change it before I send it out to you. But this is Eastern SPF price delivered to Boston. So we're looking for essentially flat prices this year. Well, actually, that's not true. So it's a bit flat prices from where we're at right now, I should say. It's about a 10% increase from where we were in 23. In the very near term, we are looking for prices to come off, but because of elevated costs, we don't see prices having a lot of room to drop. And then as we move into 25 and we have increased demand, because of elevated costs, with that increased demand, we do see prices starting to move up a little bit more. So, but again, like I said, very near term, we do see prices coming off. Why is that? Well, for one thing, inventories are decent right now. So these are dealer supply. So this is the month supply that dealers have. The blue bar, or the blue area shows the 24-year high. The top shows the 24-year high, and the bottom shows the 24-year low. You can see that 23 and 24, we basically have been pretty much right in the middle of that. So inventories are a bit lower right now than they were last year, so that provides some upward push on prices, as does a lot of the capacity curtailments that we saw in the earlier part of this year. But for now, we do see inventories being sufficient, that with the higher prices that we've seen, with the price increases that we saw in March, we're seeing dealers moving to the sidelines, and so we do expect to see prices come off. In addition, from a mills perspective, mills are making decent money, so they're not going to be cutting back on production in the near term as dealers are stepping to the sidelines. So what this graph shows is the bars show you your cost, and the green dot shows you your price to cost ratio. And then that solid black line going through shows you your break-even price. So when the green dot is above that black line, mills are making money. When it's below that black line, they're losing money. So you can see that across all region, mills are making money. And so we don't expect to see much in the way of closures until we see prices come down and those dots drop below that black line. And then as we move longer run, we do see costs remaining elevated. That fiber supply balance that we're seeing across regions with the declining fiber supplies in the West, both in the US and in Canada, and as we see wood set aside for the woodlands caribou, or timber set aside for the woodlands caribou, and some of the results of the fires in Eastern Canada, we do see a continued upward pressure on costs. And then finally in the South, which has always been the low cost region, or at least not always, but over the past 10 years or so, we do see those timber costs starting to move up because of that massive investment that's occurred and increasing demand on the resource there. So all in all, across all regions, that upward pressure on costs leading to higher prices as well. So just to wrap up, my take home points would be that at most, we're going to see modest growth over the next 12 months or so in demand. Capacity is expanding, but it's really difficult to achieve nameplate capacity, and we're seeing a lot of that capacity expansion being offset by closures in regions with a lack of timber. Exports aren't going to really lead towards much increase in demand. There's really no increase there. And on the import side, we're not looking for a major decline in imports that would boost demand on North American mills. On the other side, there's not really a lot of room to increase imports as well, because Europe does, as European demand increases, they are going to shift wood from the export markets back into their domestic markets. So imports remaining roughly flat, and then we do see costs remaining elevated, which will hold prices higher over the longer run. So with that, I will, I think I've saved about 10 minutes or so for questions. Oh no, 2 minutes. Well, I have time, so happy to answer any questions folks have.
Yeah, we can go a few minutes over, and I appreciate people staying with us. One of the things that I forgot to mention at the beginning of the webinar, unfortunately, but I'll mention it now, is that you can type in your questions. If you go to the GoToWebinar control panel, you just expand it, clicking on the red arrow in the upper right-hand corner of your screen, and then click the triangle next to the questions panel, and you can type in your questions at any time, and I'll ask them of Paul. I'll give you a couple to get started. One is that the last year we saw really unprecedented fires in Eastern Canada. Obviously there's impacts from weather, there's impacts from climate change, there's a lot of different impacts, but I mean, it's impossible to really predict for sure, but do you see that happening again this year? Or like, is there some kind of structural thing that's happening with the forest management there, or was that just sort of a anomaly, do you think? Or, I mean, it's hard to say for sure, but what do you think?
Yeah. First off, let me put it into perspective. And so this just shows you. So I had mentioned the 40 million acres that had burned. This shows you the past 14 years of wildfires in the U.S. and Canada. And then this shows you, this is where we were in, it's not laughing, but it just, it was incredible. So when you say that we had a lot of wildfires in Eastern Canada, Chris, it was unprecedented, the amount of wildfires that we had across Canada. So I would say that generally when you have a really high fire year, after that, you don't tend to get as big of fires, simply because a lot of the fuel has been burnt. So I would say that this is an anomaly, and I would not expect to see continued wildfires on the scale that we saw in 23. Having said that, so if we're going back, so 17 and 18, I know it really pales in comparison to what we saw in across all of Canada in 23, but these fires were mostly in British Columbia and Alberta back in here. And so we have had, over the past 6 or 7 years, we've had 3 years with major wildfires that have impacted the supply. It impacts the short-term supply because your harvesting crews go to help fight the fires. It impacts the sort of after short-term supply because you have to salvage that wood, so it actually increases the supply of timber. But then longer run, it decreases the supply because you've lost a bunch of timber, and so your incremental growth per year, it goes down because you just don't have as many trees anymore. So yes, so I would say that I would expect to see I would expect to see far lower fire activity in 24 and 25 than we saw in 23, but potentially elevated relative to where it was, say, in the 1990s and 80s in that period. And just as long as we're on this here, I'll just pop up to the next slide so you can see the percentage of mills that were near, that were within 50 and 100 miles of the fires. You can see, in Alberta, pretty much all of the mills were within 100% within 100 miles of the fire. So what's your procurement circle? If it's 50 miles, 85% of the mills were within that. In British Columbia, it was 46%. So there's a large portion of these mills are going to be impacted by the fires.
Okay, along those lines, Quebec is dealing with a pretty significant infestation of spruce budworm. How do you think that's going to affect both timber supply as well as perhaps fuel for more fires? Yeah,
so it'll be so that in the short term has the potential to increase the supply. It's also lowering the cost of. If I go back up, it's also lowering the cost in Quebec. You can see Quebec is down here at the low end of the cost curve, and Quebec and Ontario together. But you've got the salvage timber, which is going to keep downward pressure on their costs. It's going to increase the supply in the short term, so that should benefit Quebec in terms of their ability to produce lumber and their competitiveness of producing lumber over the 24-25 period. But then longer run, it's going to decrease the supply, and you'll see in the same way that we saw supply declining in British Columbia in the aftermath of the mountain pine beetle epidemic. So it'll be our expectations in the medium term is that these annual allowable cuts are going to come down dramatically because of the combination of the fires and the woodland caribou, set-asides for woodland caribou, and and the spruce budworm.
Okay, another question that came in is carbon sequestration programs are being discussed very widely right now, and setting aside forest acres and that sort of thing from harvest to sequester carbon. Do you think that's going to affect log supply and forestry management going forward?
It's a really good question, and one that we're and one that we wrestle with, because at the end of the day, so I think it has a, so there's not a short answer to this. So I'll try to keep it as short as possible, but there are conflicting issues, because right now all of the benefit, with the exception of within Georgia in one building, has accrued to the timberland owner. So all of the carbon, it's all about carbon capture and paying for carbon capture. But we are just now, and so that's where the money's going. And so timberland owners are thinking about, about setting aside timber to, for that carbon capture and trying to monetize that. So what I would say, if you're a timberland owner, you have across your track, you have timber that's more expensive to harvest and timber that's less expensive to harvest. So if you're going to set aside timber, you're going to set aside the more expensive stuff and continue to or perhaps even stuff that you would have never harvested in the first place, and then continue to harvest at the same rate. So I guess the short answer is, our assessment is that we are not likely to see a dramatic decrease in supply because of set-asides for carbon capture. I do want to spend a little bit more time on this, one in two regions, one in Europe, and I'll throw up a slide to show you why, but also within North America, because there's carbon capture and then there's carbon storage. And it's one thing to capture carbon, but it's another thing to store it for an extended period of time. And most of you probably know this already, but if you just leave the tree in the woods, eventually, the branches start to, as it ages, the branches start to fall, the needles start, the needles are falling. You may have a forest fire. So eventually the net gain in carbon goes to zero eventually, in terms of the carbon capture. Whereas if you cut the tree down, plant a new tree, and you take the tree and you turn it into lumber or panels and you put it into a building, then you get another 100 years out of that. So, the narrative around carbon capture needs to change to carbon capture and storage. And so we need to be seeing the credits going to both the capture of the carbon and the use of that carbon in a product that's going to be stored. So where is that? You could argue as to, is that use in the production of the lumber and the panels, or is that use by the contractor who's actually building the building out of wood instead of concrete or steel? So we're starting to see a movement in that direction. There was a building that went in down in Georgia, and we actually have a conference in New York. You can see where it is on our website. I should know this, but I think it's May 1st and 2nd, or May 2nd. Yeah, May 1st and 2nd, I think. And Troy Harris, who was actually involved in this project, is going to be speaking there, and he's going to talk about it. And so in any case, we're starting to see some credits going to, and some talk about credits going to the actual storage of carbon as well. And ultimately, long run, if we're going really longer run, if we start seeing too much timber being set aside for carbon capture, in just being set aside for the timberland owner, and the credits all going to the timberland owners, then we're going to see less lumber being produced. We're going to see more buildings would then have to get built out of concrete and steel, which is going to increase your carbon emissions relative to if we were building out of wood. So then the environmental movement would be forced to shift towards looking at both capture and storage. So we think that long run, we are going to move to our capture and storage environment. We're not there now. So this is a really long way of saying that within North America, we don't really see the carbon credits as taking away a significant amount of volume available for fiber. That it's a different story in Europe, and I just want to pop this up real quick, which is that there are a bunch of changes. So the LULUCF has already occurred in Europe. That's regulation that's taken place. It's a massive increase in the amount of carbon that the forests have to store by 2030. These regulations are changing in 2026. There's also the biodiversity strategy for 2030, which is not law, but it's a goal. Let's see if I can fast forward to the next one. You have your nature restoration regulations. You have your EU forestry strategy for 2030. So these are non-binding, but the bottom line in all of these policies is that the Europeans are looking at land and forests in particular as a way of capturing and storing carbon. And so I do think that you are going to see a decrease in availability of timber for the Europeans to turn into lumber or sawn timber, as they call it. And so that is going to affect their 2.5 to 3 billion board feet of shipments into the North American market as we get to the second half of this decade. So while it might not be of utmost concern to a lot of folks on this call, because, hey, why do we care about Europe in 27, 28, 29? The reality is they ship a lot of wood into the Northeast. So, you know, a lot of wood that's getting used here is coming in from Europe and across the Eastern Seaboard. And so that supply longer run is almost certainly going to decline.
Wow, complicated topic for sure.
Yeah, that's a day-long topic.
Yeah. Moving on to another one. Broadly speaking, lumber markets fall into hardwood versus softwood. What, you know, do you see divergence there in the performance of those two markets? I know hardwood is, my understanding is that it's more influenced by exports, particularly to China. You know, what are you seeing and going on with those two markets?
Yeah, so we do see a divergence there, and for that exact reason. So the Chinese economy is not going to do well going forward. You know, I talked about that a little bit. I didn't talk that much about the Chinese economy, but if we're looking here, I know I keep on doing this, but I'm gonna throw up another slide here. So if we look at what's the long run potential for China, we have, so in the long run, economic activity is determined by either working age population growth or increases in productivity. So what's happening in China? Well, their birth rates have plummeted, right? So they're well below where they were during the Great Famine, when China had hundreds of millions fewer people than they have today. So as a birth rate, it's just tremendously low. If we look at their working age population, this is Japan, and this is Japan. So I don't have, it's not the same x-axis, right? So it's different. So this is historical Japan versus current China. You can see that in 1990, which is when Japan started its decade of lost growth that has turned into 3 decades of lost growth. That all occurred as their population started to decline. China's very closely getting to that point in time. There's some folks say, well, it doesn't really matter because you still have urbanization, but the reality is that urbanization in China is it's getting pretty close to its peak. So yeah, it's tough. I mentioned this earlier, China's overly reliant on manufacturing exports. It's more than 8% of its GDP. Their non-financial sector debt is incredibly high. It's 228% versus 100. Everyone talks about how high our debt is, but their debt's quite a bit larger than the U.S. debt as a percentage of GDP. So China's in rough shape. So I think in terms of exports to China, we're going to see continued difficulty there. Yeah, and then the place where you're going to see the most growth going forward, well, not growth, population growth, is actually India, not China, and there's a lot lower usage of wood in India than there is in China.
Okay, moving on to another topic, and I'm going to combine two questions here and talk about workforce and capacity. You mentioned workforce as a limitation in mill capacity, you know, reaching their stated, you know, theoretical capacity because of workforce limitations. That's also a big impact in logging capacity. We're seeing an increasing number of loggers aging out of the workforce. Pre-COVID, at least, we were seeing rural counties where a lot of this forestry occurs, losing population, and the people that were left a lot of them are retired. Increasingly, sort of ironically, there's a lack of housing available in many of these areas as well, which was cited as some mill closures in the U.S. West because they could attract workers to move in, but there's no place for them to live unless they build housing for them. So how do you see the labor constraints affecting the supply chain and the economic outlook for forest products?
Yeah, so that just feeds into our the slow growth in output despite that increase in capacity. So so our forecast, we actually take that into account when we look at our ability to increase production versus the capacity numbers that we showed there. You know, that growth in capacity far exceeds our growth in production. And part of the reason, and I actually didn't mention the logging supply chain, which I should have, but you know, I talked about the equipment manufacturers, the you know, the folks to build the mills, to get the wood to the mills, to operate the mills, but also the logging supply chain absolutely is impacting the ability of these mills to ramp up to nameplate capacity. So that's going to hold it down.
Great. So we're over a little bit. I thank everyone for their time and sticking on with us. And thank you very much, Paul, for your extra time here. With that, I'm going to take control of the screen just for a brief minute here and share my, yep. So all our webinars, including the recording for this webinar, so all our webinars past, present, and future live at farmcredities.com/webinars. That's where our announcement for upcoming webinars are, as well as recordings and presentation materials from past webinars will be archived. As I mentioned, the continuing ed credits, email me if you need proof of attendance for your continuing ed credits. Here's a summary of what we've gotten pre-approved for on the screen. Other states will accept proof of attendance without pre-approval, I believe. So email me if you need those for your CEU credits. And with that, we will sign off, and I thank you all for your time. Thanks a lot.